I want you to quickly imagine this scenario with me. You are given a warning that an earthquake is coming soon. You don't know exactly when, you just know that it will happen soon. Now you also know where, and it's going to be right in your backyard. So the question is, what do you do differently to prepare? How does your focus change for the next few years? Do you try to ignore the issue, laugh it off, pretend it's not coming, or do you start actually preparing? I think it's sad but fair to say that a lot of people would probably do nothing because thinking about bad things is not very fun. Well, I never do videos like these, but a storm is coming and I feel obligated to talk about it. What if I told you that Jamie Dimon, he's the CEO of Chase Bank, the largest bank in America and probably the world, called what we're going to talk about in this video the most predictable crisis ever in history. And just weeks before that, Jerome Powell, the chair of the Federal Reserve and one of the most powerful people in the world, warned that we are on a dangerous and an unsustainable path. Now, since we are in a super politically charged environment, let's talk about Jerome Powell for a minute. He's basically the guy in charge of making sure the US financial system runs smoothly. And it's probably worth noting he was nominated by President Obama, promoted by President Trump, and renominated by President Biden. He's not just some bloke on the political fringes. Now, the issue both of these men were speaking about was the US national debt. So, in this video, we're going to take this sequence step by step so you understand what is happening, what will happen soon, and how you're going to be impacted wherever you are in the world by this. The first trigger you're going to start to see is interest payments on US debt. If you've ever had a credit card, you know you've got to pay interest, and the government is no different. Now in 2024, they're guessing those interest payments will be in the range of $870 billion for the year. And if you're thinking that's not really that much money for a government, here's two stats that might help you. We're going to spend less than that on our entire national defense for the entire year. $1 billion is $1 million 1,000 times. It's a lot of money, and we're spending 870 of those on nothing but interest. That means that if you pay taxes, about 20 cents of every dollar that you're paying in taxes is going to just pay interest on government debt. So those payments are quickly getting very big, and here's how this starts to play out. First, the US will need to start printing or creating more money to keep up with those debt payments if they don't take care of it soon. Now, we know from history just a few years ago that putting a bunch more money into the economy will kickstart inflation again, which is something we were just kind of getting starting to beat. Now, in order to combat inflation, the US Federal Reserve will raise interest rates. And again, this is not something that's far out. This is exactly what happened just a few years ago with COVID, and they've already raised interest rates and left them there as of the time of this video. This is what the Federal Reserve does. They don't really have a choice. They have a mandate to maintain a certain inflation rate, and if it goes above that, they need to raise interest rates because that will slow down the inflation rate. Now, a smart government here would probably also maybe spend a little less and perhaps tax a little more, but that's going to require compromise, so that's not going to be an assumption we're going to make here. But as interest rates go up, there's going to be three big things that happen. First, you're going to see businesses spend less and borrow less. That essentially means they're going to invest less in growth. It's expensive now for them to do that, so they're going to do it less. Second, you're going to see investors invest less in business because they can get an 8% guaranteed return on a savings account. Why would they go make these risky investments in business? And third, regular schmucks like me and you are going to spend less because credit is expensive, and we'll just see an overall slowdown in spending. So the natural effect here is we start to see business growth start to slow down. They're making less, it's harder for them to borrow money and harder for them to grow. And if you combine that with the next 5 years of job loss due to AI, which I think we all can agree is going to happen, things start to get pretty tough in America. Number one, it's going to be very natural that unemployment will start to go up. And number two, buying things becomes more expensive because of inflation, and we've already seen that. And number three, borrowing money, even HELOCs, is becoming more expensive, so that becomes less of an option too. Now let's talk about how this starts to impact the housing market. If you've been alive for 15, 20 years, you've seen this. For houses, interest rates start to get too high to buy houses at current prices. Honestly, it's kind of there already, but somehow we're kind of holding on, and things will more than likely get worse if inflation kicks in again. I've been buying houses every year for about 5 years, and mortgage prices have almost doubled, and most of it's just coming from interest. So houses aren't going to be able to sell for what they were selling for because there's this extra $1,000 to $2,000 in interest payments tacked on. The natural natural effect there, right, is the actual value of a house starts to drop. Now you might think that's good, but let's continue on here. What happens is we get all these people that are now underwater on their mortgages. So they can't go sell because instead of selling, putting money in their pocket, they would actually owe the bank money. They'd owe a lump sum if they sell, right? They can only sell a house for $200,000, but their mortgage is $250,000. So they lose $50,000 when they sell. They also can't refinance because one, they probably don't have equity, and two, interest rates are really high. They can't get a HELOC, again, equity, interest rate. But we have all these people that can't afford their homes because of job loss and inflation, so they need something cheaper. So again, the natural sequence here is we start to see foreclosures start to pick up. And we've actually already started to see that now. Now there's still not a ton of demand because interest rates are high, and when supply goes up, demand doesn't follow, economic kicks in. And they can very easily go into a mega free fall, and that's what happened in 2008. If you take a look back 15 years at a housing chart, they were in a free fall. Now, the way we stopped this in 2008, and by the way, I'd recommend the movie The Big Short if you want to get a little bit of an understanding of this, but essentially the government spent a ton of money, they did major tax cuts, and they cut interest rates to zero. And that helped things get moving again. It kind of greased the wheels again. But we can't do that now. We're in too much debt to do another huge push like that. And the fact is the Federal Reserve really can't lower interest rates because their focus is stability, their mandate is stability, and they're trying to maintain about a 2% inflation rate. So even if it hurts, that's what they have to do. They also can't turn on that money printer, right? We can't just produce more money and inject it into the economy because that's what caused the damage, and it's already causing inflation. So we can't continue to do that. Now, we also can't borrow because interest rates are high and it's expensive to borrow. Plus, at some point, lenders start to look at the US balance sheet and wonder if they're going to get paid. So one more direction, we're going to see a big impact here, and that's the US dollar. Currently, the US dollar is the international currency of choice for international trade and reserves because it's a stable currency. So currently, the US can print money, and we can produce more money, and we can borrow like there's no tomorrow. And because we're kind of the gold standard, it doesn't have as big of an effect on the US as it does elsewhere. But what you see is as the US dollar starts to become a little more unstable and less consistent, other countries that currently use that in their reserves start to look elsewhere, like real gold, for example. Now, if you look back at history, the US dollar has recently been crazy strong, meaning that we've been able to import stuff for very, very cheap because our dollar value is high compared to other currencies. For example, if I head down to Mexico right now, I can get fed for just a couple bucks, which is extremely cheap by US standards, and a lot of that is due to the power of the US dollar right now. Now, as countries leave the US dollar, it becomes weaker. We don't have that same level of strength, and that means that importing things gets more expensive. It costs more. So we can say goodbye to our cheap Timo and our cheap Amazon junk that we buy every day. And we can say hello to more inflation. Now we can also say goodbye to stock market gains for a few years, which you might cheer for until you realize that it's your IRA and your 401k, not just some schmucks on Wall Street's bonus check. And again, this is not far-fetched. This is already happening. In 2009, Brazil, Russia, India, and China formed an organization called BRICS, which essentially has the goal of removing the dollar as the primary currency for trade. Now, BRICS is growing with dozens of countries joining since and dozens more applying or looking to join. And this isn't because all the countries hate the US that are joining, it's because they see writing on the wall and they're looking out for themselves. So, what does this mean for you? What does this mean for me? What it means is that tough times are ahead. None of what I've said is fringe. None of what I've said is a major conspiracy theory. Rather, if you look into the natural cause and effect based on the current trajectories and policies that are happening right now, and you just look at what's going to happen 10 to 15 years from now, this is what's going to happen. And this is not just me, Spencer, saying this. This is coming from some of the most powerful and influential and respected minds in the finance world. Now, I'm going to make more videos next on preparing and maybe thriving off of this environment because the last recession, a lot of people came out actually pretty far ahead. But for now, 1, make sure you have a savings account and you don't have a major debt sitting over your head. 2, you need to own hard assets, assets that can hold value in hard times. 3, become invaluable at whatever it is that you do to earn money. Become the best. And 4, build a network. A network will absolutely be huge during tough times. A storm is coming. Preparation is your choice.